Hi, my name is Alyssa Roush, Senior Tax Manager in EisnerAmper's Private Client Services Group. Today, I am here to interview Scott Testa, tax partner and leader in our Trust and Estates practice. We're going to have an opportunity to understand Scott's take on T&E strategies and solutions. Thank you for joining me, Scott.
Thank you, Alyssa. It's great to be here.
Great
Hopefully
to
we
have
can
you.
have some fun with trust today.
We definitely will. So let's talk about decanting. For wine, decanting is the process, as you know, of transferring wine from a bottle to a container and leaving the sediment at the bottom. Is decanting in the trust world similar in that you're leaving the bad provisions in the old trusts and then transferring only the good provisions in the new trust? And why would someone decant? What are the income tax consequences, if any, and how does it all work?
Exactly. It's a actually interesting topic to start with because a lot of times we get questions on decanting. People don't no longer like the terms of the trust. A lot of people do estate planning that involves setting up irrevocable trusts, and it's tough to change the terms of the trust, or they don't no longer like the terms of the trust. They no longer apply. The best example is when you have a trust that's payable to the beneficiaries, their children, their heirs, at certain ages. They say age 35, for example, and the kids start reaching adulthood in 20s and early 30s, and the grantor no longer realizes that the children no longer should probably receive those assets at those ages. So they might want to extend the terms of the trust. Another reason could be to correct some ambiguities in the trust or possibly move situs of the trust. But decanting is done for another reasons. It could also be done to merge trusts. So when you decant, you're moving assets from one trust to another. Another from an old trust to a new trust. And it's supposed to be a continuation of the old trust into the new trust. But many provisions, a lot of decanting is done. The first thing you want to look to is the trust document to see if decanting is permitted in the trust. In other words, there could be a broad discretion to distribute assets from one trust to the other. So a lot of times the trustee will rely on that rather than a state's trust decanting statute. So we look to the trust document. If in the best interest of the beneficiaries it can be done, you distribute one assets to the other. So as far as income tax consequences, like I said, it's supposed to be continuation, but a lot of times it's based on a distribution. So that distribution from the old trust to the new trust will generally carry out income like it would on a normal distribution, but that trust will terminate and any tax attributes in the old trust will move into the new trust. So there really shouldn't be any tax consequences upon a decanting.
All right, so let's jump into a new topic, grantor versus non-grantor trusts. Which one is the best? So with a grantor trust, we know that when the trust generates income, the grantor unfortunately has to pick up the tax bill. However, with a non-grantor trust, it depends on whether or not the trust is simple trust or a complex trust, and I want to know which one is the better one. But with the simple trust, everything that gets distributed to the beneficiary pays the tax on the income. But the trust itself would pay the capital gain. However, if it's a complex trust, then only the amount that actually gets distributed to the beneficiary does the beneficiary have to pay tax on. So why do, when people, grantors or settlers, come in to set up their trust, what makes them want to choose a grantor trust versus a non-grantor trust? I always wondered this, and also wanted to understand why simple versus complex, and how does the trust instrument play into all this?
You raise a lot of interesting topics, and the first thing you have to do is have to understand what's the difference between a grantor trust and a non-grantor trust or simple and complex trust. But I have to say, a lot of times, the most frequent question I get, a lot of times from colleagues, sometimes from clients, is what kind of trust is this? Is it a grantor trust for income tax purposes where the grantor pays the income tax on it? Is it a simple trust that requires all income to be distributed currently? Is it a complex trust? And they want to possibly do some income tax planning or even estate planning with it. But with a grantor trust, like you said, the grantor retains certain powers over the trust where he's taxed on the income. That could be, if you have a trust where there's a power to revoke or a power to retain income in the grantor or his spouse, then that trust will be a grantor trust. It will also be essentially an incomplete gift trust, and as the grantor can, like I said, retain the power to revoke it, and it's essentially a will substitute. But if you're doing an irrevocable trust that's either grantor or non-grantor. If it's grantor, the grantor will pay the tax on it. It's a great estate planning move because the payment of the income tax by the grantor on the income that stays in the trust is not considered an additional gift. So therefore, it's a way of getting more money out of your estate, and more assets can stay in the trust for future generations. Now, whether you want to go with simple or complex, a simple trust requires that all income be distributed currently. So you have to think about who the beneficiaries are, if you want to make distributions currently. If you want to make them discretionary, a lot of times it's limited to health, education, support, and maintenance, or the trustee can allow for distributions in complete discretion. And you have to look to see who your trustee is as well, because if you're dealing with a corporate trustee, and you want to make sure distributions either go to your spouse or your kids, you might want to put mandatory provisions in there. But, again, the more assets you can stay in an irrevocable trust, the more assets that will be out of the estate of the spouse or your beneficiaries. So you have to consider all of those things.
So you really have to think about who the beneficiary is. I mean, and who would be getting the money in the first place, and how do you want that to work out? What's the timeline? And also, it sounds like with the grantor trust, that's kind of a nice tool because then the grantor pays the tax, and then the trust itself, the assets don't get depleted, right? So you're able to keep a lot of the value of the assets in the trust and out of the estate.
Exactly. And with a grantor trust, the grantor is going to pay the income tax on it, no matter who receives the distributions. So you have to factor that in as well. You have to look to see who the trustee is. And as I say, any trust question that you're going to have is going to relate to what does the trust document say. So it's important to examine that and see when distributions are to be made and if it changes from year to year.
So the next thing I wanted to go into was I wanted to dive into residency trusts because I have a client who the only reason why the trust itself is considered a New Jersey resident for the mere fact that the trustee is located and is a resident of New Jersey. Had they not had a trustee in New Jersey, then they would be able to save at a tax rate of almost 11%. As you know, it's pretty high in New Jersey. So is there a way to set up a trust so that it's exempt in a state, or at least pays at a lower tax rate? How does that all work?
Each state, the residency of a trust is usually determined at the state level. So a lot of states have set up a rule that a trust is resident in that state if it's set up by the grantor who is resident at the time he makes a gift to the trust, or the time it becomes irrevocable, or at the time he dies. It is then a resident and will always be a resident trust of that state. When you're dealing with a resident trust, you can still have a trust that's resident in the state, but yet exempt for income tax purposes from that state. And New York, New Jersey have the same rule. Some states have the same rule that say if all trustees, all assets, and all income is out of that state, that trust will not have enough nexus to be taxed there. It will not be taxed in that resident state, and it won't be taxed in any state as long as there's no income that's specifically sourced to a state. So if you're dealing strictly with intangibles, intangibles don't count as assets located in that state. So it is possible, and this is one of my favorite moves, if you kind of have a trust that's resident exempt and it pays no tax in any state. Now, it has to be a non-grantor trust because a grantor, as we said, will be taxed on all income of the trust. So it has to be a non-grantor trust, and it's only on the undistributed income of that trust. So if the trust can retain the income, the ordinary income, the capital gains, they will all escape state taxation. And again, every state has different rules. Some states want to tax where the trust is administered, and each state has their own rules. So you need to consider that if you plan on setting up a trust, where you set it up, or even if you want to decant it and move it to a trust and possibly change the situs.
So careful consideration should be made to whoever the trustee is when you're forming the trust. Who's the trustee? Where do they reside? Who's the beneficiary? Where do they reside? And looking at all those factors, because maybe you could strategize, and try to reduce the amount of tax, at least state-wise.
Right. Trusts are set up for all different reasons. I mean, it's more than just income and estate tax, because you're dealing with asset protection, creditor protection, divorce protection, protection from the beneficiaries. So you need to consider all these things. But there's a number of income tax savings moves as well, and this is one of my favorites. The example is I had a client that had a trust. It was a grantor trust. He no longer wanted to pay the tax on it. He had private company stock in there, was going to sell the stock at about an $8 million gain. and wanted to turn off the grantor trust status on it, so he didn't pay the tax on it. And his brother-in-law was the trustee who resided in New Jersey. I was like, well, if you move the trustee, you change trustees to a non-New Jersey trustee, it will completely escape state taxation. So it was a great move, and it saved, up to 10% of the income tax on the trust at the state level.
So the other thing I wanted to go over was your favorite tax strategies. So as I call the alphabet soup of names, there's the grats, the kluts, the crats, all these different kind of thing. I know you wanted to coin your own trust. What was it going to be? The test trust?
Well, first, it depends what your goals are, what the client's goals are. And, you need to look at estate planning, income tax planning, like I said, asset protection. But from an estate planning standpoint, if you have a trust and you have a lot of clients that are reluctant to give away assets, so they might set up a trust where the spouse is a beneficiary. So you have that out. You can take distributions to your spouse, indirectly through you if you want to set up a trust and you want to make sure you retain some assets or some right to that income that's in the trust. It's a great estate planning move. It is a grantor trust because your spouse is a beneficiary, so it does have the tax burn. It gets assets out of your estate. Like I said, a lot of clients are reluctant to start setting up trusts to give money away. So I was at a conference, we talked about setting up a test trust. I'm like, let's give it a name, let's give it an acronym, we call it the Test a Trust. And, it's just a mechanism to get clients comfortable with giving away assets and getting used to having a trust and see if they can do some income tax planning on it. Once they get used to it, they can then, continue to make gifts, annual exclusion gifts, use their lifetime exemption to get assets out of their estate.
Yeah, I find a lot what you were saying in terms of control. A lot of the clients don't want to give up control yet. They're not quite ready. So I see where you come from that. The other thing that when we discussed was I wanted to go over the most frequently asked questions that our clients ask us in our trust and estates practice and kind of throw them at you and see what your thoughts are.
Okay.
You kind of addressed this one a little bit earlier, but we'll kind of go in a little more depth. How do I change my trust from a grantor to a non-grantor trust? How do I do that?
Well, first you have to understand what makes a trust a grantor trust, and there's certain powers over the trust. Some make the trust incomplete, like the power to revoke, power to retain income, but there's other provisions, call it a loophole, call it what you want, where you have a completed gift for estate tax purposes, but it's considered disregarded for income tax purposes. The grantor could retain certain powers, like the power to substitute assets or the power to use income to pay for insurance on the life of the grantor. That power to reacquire trust assets is a typical trust provision that would make a trust a grantor trust for income tax purposes. And a trust should be flexible enough to allow the grantor to toggle on or off that power. So if you have a trust that's a grantor trust and you no longer want to pay the tax on it, maybe there's a big gain that's going to be in the trust, or you just want the beneficiaries to pay their own tax or the trust to pay its own tax at this point, you could toggle off that grantor power.
Okay. So a lot of times people talk about, and you kind of addressed this earlier with kids, what are the tax advantages and disadvantages of making a distribution to a child? I know there's obviously that they could be at a lower tax rate. Well, of course you have to factor in the kiddie tax, but maybe sometimes you don't always want to do that, and maybe why?
A trust could be used for income shifting as well. You can move trusts to beneficiaries who might be in a lower tax bracket. Like you mentioned, there's kiddie tax applied that might be taxed at the parents' rate, but adult children could be in a lower bracket. As trusts were set up so that they're taxed at the highest rate, at least at the federal level. You had a very low level. For 2023, that number is $14,450. Anything above that is taxed at the highest rate. So there's flexibility there to make distributions and distribute assets to beneficiaries who might be in a lower bracket. The next question we sometimes get is from a client, if there's a big gain in the trust and they want to distribute that gain to the beneficiary, is that permissible? Because under the typical terms of a trust, capital gains are considered corpus and are taxed to and retained by the trust. But there is a way to allow for distributions of capital gains to a beneficiary. One, the trust document could allow for it, capital gains to be allocated to distributable net income, or if the trustee regularly and consistently distributes out the proceeds to the beneficiary. So you have to think about whether you actually want to do that. You also, distribute out proceeds from the sale to a beneficiary to distribute out the gains, because you actually have to distribute out the money to the beneficiary. So that's one of your considerations as well.
And it could be very powerful if you do distribute out the capital gains, because if, like you mentioned, if the child, let's say, or the young adult has huge capital loss carryforwards at their individual level, and then they transfer the capital gain out to them, they might not have to pay any tax on it because the losses will absorb the gain and the trust won't have to pay tax on it. So that could be a really powerful mechanism.
Right.
Typically, we're always told that trust pays the capital gains, on the tax on it. But you're saying there is a way out of that, and we could structure it.
Right. If you want to regularly and consistently distribute out the gains, it's something you can do. But this should be done essentially from the onset. Again, this only applies to non-grantor trusts. The other thing about state income tax, that the beneficiary might be in a no-tax state.
Right.
Therefore, if the trust is in a state where it's paying income tax, if you distribute out the gains to the beneficiary will pay no state tax.
Right. The other thing is trusts reach the highest tax bracket much faster than individuals, just the way the tax rate schedule is, as you know. So a lot of questions we have from clients are, well, why should I set up a trust then?
Good question. Let me think about that for a second.
Well, sometimes it's not always for non-tax, sometimes it's
Right.
for non-tax reasons to get it out of your, estate. It is more for non-income tax reasons, but it is for estate tax reasons to get
Right.
your assets out of your estate.
Right.
So,
There's several non-tax reasons for setting up a trust. Like as I mentioned, it could be for asset protection and creditor protection.
right.
So, and then you could set up a dynasty trust that is out of the estate for, your children's and future generations. So it's a powerful tool
So if you
for
keep
estate planning purposes.
if you keep assets in a dynasty trust, basically you're able to keep it out of the estate and you don't make any distributions out of it for years and years to the beneficiaries. You can keep it out of beneficiaries going for generations. So it could
Correct.
be really powerful.
Right, and if the trust only allows for discretionary distributions, again, if the money is needed, you could distribute out the assets to the beneficiary for whatever purpose, if they're buying a house or for whatever reason, or you can keep the assets in the trust if needed.
The other question that comes up is, let's say the trust makes a donation to charity. It seems like it would be an obvious thing, but can the trust claim a charitable deduction?
Well, the first thing you have to look at, like I said, the answer to any trust questions was, what does the trust document say?
Right.
The trust has to allow for charitable contributions. It's got to be written in the trust. That's number one. Number two, it's got to be out of trust income. So trusts don't have the same rules that individuals do, whereas there's a limit to certain percentage of gross income. As long as the payment to the charity is allowed under the trust document and is out of trust income, then the trust can take a charitable contribution deduction. So distributions to charity of appreciated securities don't count because that's considered principal. That's not out of income. But gains do count for income for that purposes. So, and the other thing to consider is that, other than not being limited to a percentage of gross income, trusts can make distributions to foreign charities where individuals can't. So if somebody wants to set up a trust and be able to take distribution deductions to charity, you could set up a trust for this purpose to allow for charitable contributions to a foreign charity.
So what are some trust income tax strategies that you could apply or implement?
When dealing with non-grantor trusts, there are certain ways to possibly save some income taxes. Like I said, there's the resident exempt trust that could be exempt from any state taxation. But also, trusts are allowed to take additional deductions that individuals might not be able to take. In other words, if you have a non-grantor trust, you get an additional tax deduction. Right now, there's a state and local tax limit of $10,000. You can get an additional $10,000 income tax or property tax deduction. Tax prep fees are deductible by trusts. The big one here, and we've been seeing a lot of this recently, is a 1202, qualified small business stock, which allows you to exempt up to $10 million of gain from federal taxation. By setting up a non-grantor trust, this gives you an additional $10 million exclusion. So it's a way to stack and pack that $10 million exclusion from gain. So it's a powerful move if you have qualified small business stock. Also, we're currently dealing under the Tax Cuts and Job Act with the qualified business income deduction. Trusts get that additional deduction if you have a specified service, that if the grantor is over the limit on the deduction that's allowed, if your income is below a certain threshold. But the trust gives you an additional threshold to take the qualified business income deduction.
So if I'm a lawyer, let's say, and I decide I have an interest in my law firm, can I transfer some of my interest into a trust? And then even though it's a specified SSTB, you could potentially, as long as you transfer the right amount of shares, a right amount, exclude or have the 20% QBI deduction? Is that what we're saying?
Yes, kind of. Although I don't know if a law firm will let you transfer your partnership income into a trust. It's got to be, again, it's got to be a non-grantor trust. A better example could be an active trade or business, or passive investment.
And also, are there any aggregation rules with regard to the qualified, Section 1202 qualified small business stock within the trusts? Like, how many trusts can you set up to get the $10 million limitation?
There is a rule, and it has been in existence for a while, about having multiple trusts. But this came into light with the QBI deduction. The IRS feared that people would set up too many trusts just to take advantage of this additional deduction. So you can't have similar trusts. You can have trusts that have different beneficiaries, but you can't have multiple trusts for the same purpose.
Mm-hmm.
So I call this the don't be a chazer rule. You can set up a few trusts for your beneficiaries, one for each child, but if you're using this trust to take advantage of certain tax attributes like the QBI deduction, the 1202 stock, it should be limited to dissimilar trusts.
So I also wanted to ask you, Scott, about the Kastner case. Can you describe to us about what that case was about and what the key takeaways are?
Sure. This was a case that involved the state's ability to tax trusts. And what was interesting about it is it's a Supreme Court case, the U.S. Supreme Court case. So they rarely ever get to deal with trust issues, but this dealt with a state's ability to tax a trust. And this was a New York trust created by a New York settler under New York law. And it had a beneficiary that had moved to North Carolina. And North Carolina wanted to tax this trust based solely on the residency of the beneficiary in North Carolina. So this went all the way up to the Supreme Court, and basically this case said that this was not enough nexus, that North Carolina could not tax that trust in North Carolina on the basis of one resident beneficiary. And again, the beneficiary was not entitled to receive distributions. They were completely discretionary. So we can use that to determine, what is a state's reach and the ability to tax a trust. Now, some states, like I mentioned, have their own rules that don't run afoul of any constitutional issues. New York, New Jersey won't tax a trust if there's no nexus there, no assets, no trustees, or no income in that state. So, we need to look at this case to determine state's ability. I don't know if any other states are going to run afoul of any constitutional issues or might be challenged, but it's just something to keep in mind.
Yeah, it really is a reminder of, making sure that you look at all the state tax rules. For each state has their own unique set of rules as to determine whether or not it's a resident trust or not in that state, or it's taxable. So that's a great summary. Thank you so much, Scott. So Scott, if you had one thing that you wanted our audience to take away from our conversation, what would it be?
The key takeaway is to always refer to the trust document. The answer to any trust question will be, what does the trust document say? This will determine who pays tax on the trust income, who is entitled to receive distributions. Are distributions mandatory or are they discretionary? Did anything change? Did a grantor toggle off the grantor trust power? Did a beneficiary reach a certain age which requires a distribution? Are you able to decant the trust and make a distribution of assets to another trust in the discretion of the trustee? These are a lot of things that are answered within the trust document itself.
Thank you for joining in the conversation and sharing such valuable insights. It's such a pleasure working with you every day, and just thank you for being here. And thank you for joining in.